In 1958, a man walked into a California bank with an idea so strange it bordered on madness. He wasn't asking for money. He wanted to give it away. His name was D. Hawk, and his invention would change how humanity spends, saves, and lives. But at the time, even bankers laughed at him, because his idea was this: what if people could buy now and pay later, using nothing more than a piece of plastic? It sounded reckless, dangerous, and to the financial elite, impossible. In the late 1950s, America was booming. Suburbs were spreading, cars were gleaming, and shopping had become a national pastime. But one thing hadn't changed: money. People still paid in cash or wrote checks, and checks were slow, risky, and easily forged. Banks hated them. Merchants dreaded them. But they were all anyone had. Then came a small bank from Fresno, California, Bank of America, with a dangerous experiment. Instead of waiting for customers to borrow money, what if the bank sent everyone a loan at once? They printed 60,000 cardboard cards and mailed them, unsolicited, to random people in Fresno. Each card came preloaded with a line of credit. The idea: people could buy what they wanted now and pay later. It was called the Bank Americard, and it was the birth of the modern credit card, a moment that would eventually create Visa, MasterCard, and trillions of dollars in digital transactions. But back then, it looked like financial suicide. Within weeks, Fresno descended into madness. People treated the new cards like free money. They bought everything: TVs, furniture, vacations, and then, many never paid it back. Stores were overwhelmed. Fraud exploded. Clerks accepted fake signatures, lost receipts, and handed out goods without any verification. One local newspaper called it the Great Fresno Giveaway. Bank of America lost millions. Executives panicked. The CEO nearly killed the program. But amid the chaos, one man saw something others couldn't. D. Hawk, a mid-level bank manager from Washington State, looked at the disaster and saw not failure, but potential. He believed credit cards weren't the problem, the system was. A centralized bank couldn't possibly handle millions of transactions across thousands of cities. The solution wasn't more control. It was the opposite: decentralization. Hawk proposed something radical. Let every bank issue cards, but connect them through one shared network, a federation instead of a hierarchy. It was the same philosophy that would one day power the internet: open, distributed, and self-governing. He called it chaotic, a blend of chaos and order. Most bankers dismissed him. They wanted control, not cooperation. They didn't trust competitors, and certainly not customers. But Hawk persisted. He envisioned a world where a shopper in Paris could buy from a store in New York, and the transaction would happen instantly, without a single central bank controlling it all. It sounded like science fiction. Yet Hawk convinced Bank of America to let him try. In 1966, he gathered representatives from dozens of U.S. banks in a San Francisco hotel. He proposed forming a new, independent organization, not owned by any single bank, but by all of them. Each member would help process transactions, share responsibility, and agree on one rulebook. They voted. The motion passed. And that's how the world's first decentralized financial network was born. Its name, National Bank Americard Incorporated. But within a few years, it would take on a new name: Visa. At first, the system barely worked. Machines jammed, records got lost, and fraud remained rampant. But slowly, something changed. Merchants realized customers spent more when they didn't have to count cash. Consumers discovered convenience, the power to buy now, pay later, and earn rewards. Each transaction became smoother. Each swipe, a small leap toward the cashless future. And the bankers who once mocked credit cards began racing to join the network they had laughed at. By the early 1970s, Visa had exploded worldwide, processing hundreds of millions of transactions every year. It wasn't just a payment system anymore. It was a symbol of modern life. But behind the smooth surface of swiping plastic, something deeper was happening. A quiet transformation that would forever change humanity's relationship with debt, trust, and freedom. By the 1970s, the little plastic card that bankers once mocked had become unstoppable. Stores that refused it were losing customers. Banks that ignored it were losing relevance. And Dee Hock, once dismissed as a dreamer, was now running the world's fastest-growing financial network. But to understand Visa's true power, you have to understand what made it different. Every financial system before Visa had the same flaw: control. One central bank, one authority, one point of failure. If that hub collapsed, the entire system fell with it. Visa flipped that logic upside down. It wasn't a company in the traditional sense. It didn't own banks. It didn't lend money. It didn't even issue cards. Instead, Visa was a network of networks. Thousands of banks connected through shared rules, shared technology, and shared trust. Each member bank issued its own cards and made its own decisions, but all of them used the same language of payment: Visa's protocols. In essence, Dee Hock created something far ahead of its time: a financial internet. He called it chaotic because it thrived on the balance between chaos and order. Just enough structure to work, just enough freedom to evolve. And it worked beautifully. Transactions that once took days now took seconds. Merchants could accept payments from anywhere, and banks could share risk and profit in ways never seen before. The power of Visa wasn't in money, it was in connection. But Visa's success didn't go unnoticed. Across the country, other banks had been experimenting with their own credit cards, small, regional systems trying to copy the formula. One of them was MasterCharge, launched by a group of competing banks to challenge Visa's growing empire. Eventually, it would become MasterCard. The race was on. Visa and MasterCard fought city by city, merchant by merchant, each trying to become the dominant standard for plastic payments. They poured billions into advertising, security, and technology. Visa's "Everywhere You Want to Be" campaign became iconic. MasterCard answered with, "There are some things money can't buy. For everything else, there's MasterCard." But while the public saw a marketing war, Dee Hock saw something else: a quiet revolution in trust, because both networks shared the same fundamental truth. The world had finally accepted money made of promises. In the decades that followed, the credit card transformed from novelty to necessity. It reshaped economies, culture, even psychology. People no longer thought about what they could afford, only what they could borrow. The line between need and desire blurred. Debt became invisible. With each swipe, the future quietly shifted into the past. Governments encouraged it, corporations thrived on it, and consumers embraced it, willingly trading long-term security for short-term convenience. By the 1980s, entire households lived on plastic, and Visa was processing millions of transactions every day. The very thing bankers had mocked was now holding up the world economy. But while Visa conquered the planet, Dee Hock began to feel uneasy. The system he'd created was evolving, and not entirely in the direction he'd hoped. What began as a tool for decentralization was becoming another corporate giant. Banks were consolidating power again. The same greed and control he'd tried to escape were returning under a new name: Visa International. In 1984, Hock resigned. He said the organization had grown too big, too bureaucratic, too blind to its own power. "The problem," he wrote later, "is never how to get new, innovative thoughts into your mind, but how to get the old ones out." He left with nothing but his philosophy, that true innovation lives in the tension between freedom and structure, chaos and order. And ironically, that same balance was what allowed Visa to keep thriving long after he was gone. By the late 1990s, Visa had achieved what once seemed impossible. It wasn't just a company anymore, it was an infrastructure, the rails of global commerce. It connected over 20,000 financial institutions, processing billions of transactions a year across more than 150 countries. The Visa logo became more recognizable than the flags of most nations. Every time a card was swiped, somewhere deep in Visa's data centers, a complex ballet of information took place: banks verifying, merchants confirming, systems approving, all in less than a second. To the world, it looked effortless. But behind the scenes was one of the most sophisticated technological networks ever built, the digital bloodstream of the global economy. And yet, as Visa grew, so did a question no one wanted to ask. Had the dream of decentralization survived? Or had Visa simply replaced one kind of control with another? By the dawn of the 21st century, Visa was no longer a network of banks. It was the invisible architecture of global trade. Every online purchase, every hotel booking, every gas pump transaction passed through its systems. Trillions of dollars flowed through its servers each year, quietly powering the modern economy. But while the world celebrated convenience, few realized the cost. Visa had achieved what no empire ever had: universal acceptance. No matter where you went, from Paris to Nairobi to Sao Paulo, the same small blue-white logo followed you. You didn't even have to think about money anymore. Just swipe, tap, or click, and the machine would say, "Approved." It was frictionless, magical, almost invisible. But that invisibility came with a price. Because Visa didn't just move money, it collected data. Every transaction revealed something: where you were, what you bought, when you traveled, even what mood you might have been in. It became the largest behavioral database in human history, built not on surveillance cameras but on spending habits. And yet people trusted it completely. They didn't question it, because it worked. The dream of decentralization had transformed into the most centralized financial network ever built, and the irony was complete. By the 2010s, a new generation of disruptors emerged: PayPal, Apple Pay, Alipay, Stripe. Each promised to revolutionize payments again, but almost all of them still ran on Visa's rails. Even the boldest experiments, like Bitcoin, couldn't escape its shadow. When people wanted to buy cryptocurrency, they used Visa cards. When they sold it, they withdrew money to Visa cards. It was as if Visa had woven itself so deeply into the fabric of capitalism that even its rivals needed it to exist. In 2018, Visa processed over $11 trillion in payments. By 2025, that number would double. It handled more value in a day than most countries did in a year. DHawk's Cordic network had become a planetary nervous system, a digital bloodstream that never slept. And yet, Visa owned nothing tangible: no stores, no goods, no currency. Its product was pure trust, the invisible bridge between buyers and sellers. That trust was its monopoly. If Visa's systems went down, economies could freeze within hours. Airlines couldn't sell tickets. Supermarkets couldn't process payments. People couldn't buy food or fuel. That level of dependence gave Visa quiet, unmatched power, the kind that never needed to shout. And it raised an uncomfortable question. When convenience becomes absolute, does freedom disappear?